Kitco News special coverage of Consensus 2024 is brought to you by Diamond Standard.
Hello, I'm Michelle Mopori, and this is Kitco News coming to you from Austin for Consensus 2024, one of the world's leading crypto, blockchain, and Web3 events. Many of the industry leaders have gathered here today, including Sergey Nazarov, the co-founder of Chainlink, who says eventually all transactions will be on the blockchain, and that being on the blockchain will be as important and as prevalent as being on the internet. Sergey, great to have you with us.
Great to be here. Thank you for having me.
Well, Sergey, we've got a lot of topics to discuss, big focus on tokenization, as well as your outlook for ETH and Bitcoin, with the recent approval of the ETH spot ETF. But before we get into that, for our viewers that are not that familiar with Chainlink, give us a brief intro and a breakdown.
So Chainlink is infrastructure that allows smart contracts to operate and do advanced kind of operations. It's also a set of protocols that allow the blockchain industry to function across chains and in relation to data. So in the internet, you have protocols like HTTPS, which serves websites like YouTube or whatever, and you have TCP/IP, over which information moves across the internet. Chainlink is a similar set of protocols and standards for how the blockchain industry works with data and connectivity across chains. And this is important because without that infrastructure, you wouldn't have the internet. And without Chainlink, you wouldn't have the growth of something called DeFi. And you wouldn't have a secure way to connect across multiple chains to form what we call the Internet of Contracts. So Chainlink is sometimes a little bit difficult to understand because it's a low-level infrastructure technology. It's kind of like the pipes of what makes a lot of advanced blockchain and smart applications work. It's kind of below the surface.
Right.
And similarly, in the internet, there's many technologies below the surface that power the internet. HTTPS, SSL, TCP/IP, that's the kind of technology that Chainlink is.
And you have really revolutionized the way smart contracts work with real-world assets and real-world data. Explain basically what that is for our viewers, the smart contract idea.
So a smart contract is a technical agent that both parties can rely on without any trust assumptions. So when you and me do a transaction, we have trust assumptions that I will honor the transaction, or that you will honor the transaction, or if I'm a big institution and you're a big institution, we still have assumptions that we won't renege on our agreement to fulfill kind of a delivery versus payment. You buy something from me, I send it to you. Smart contracts are basically on-chain code where you can encode the conditions of our agreement,
Right.
and neither you nor me can affect those conditions. So we can have a smart contract that says, if it doesn't rain, then the crop insurance gets paid to me. And if it does rain, it doesn't get paid to me and you get my premium. But you, as an insurance company, would no longer have the ability to decide not to pay me,
Right.
even if it didn't rain, because the system that is executing that agreement is outside of your control. In a traditional insurance company, that system is completely within your control. So even if it doesn't rain, you as the insurance company could choose not to pay me, then we'd have to go through a lengthy legal process. So smart contracts are basically these technical agents that operate in this infrastructure called blockchains and Oracle networks. And that's the infrastructure that we kind of work on.
Right. Eliminating the trust factor, condition is met, A triggers B, there's no room for confusion there. Just to get that basic background for our viewers, let's now focus on what you were talking about at Consensus here. And the crux of your presentation was around tokenization, saying that all transactions will eventually be on the blockchain, and that we're in fact at a tipping point where all of the world's biggest institutions are starting to look at how they're going to put their value on chain. Echoing sentiments that we heard from Larry Fink, the CEO of BlackRock, the world's largest asset manager. Earlier this year, he said that we believe the next step forward will be the tokenization of financial assets, and that means every stock, every bond will have its own CUSIP. It'll be one general ledger. Every investor will have their own number. We would have instantaneous settlement. Now, obviously, this is going to be a huge step in revolutionizing traditional finance with blockchain, with crypto. Again, as a background, explain what tokenization is before we get into why this is so momentous.
Sure. So tokenization is taking the ownership rights to something, like a gold bar, a piece of real estate, an equity, a commodity, really anything, and putting that ownership right into a blockchain in the smart contract we just discussed. Bitcoin is an example of an ownership right for this synthetic instrument called Bitcoin. Real world assets are an ownership right for real world things: real estate, commodities, equities, gold, and so on. And the transition that Mr. Fink describes is the one where the use of tokenization will no longer be limited to, we make a token about, table coin, and table coin is worth whatever you and me are willing to pay for it in the open market. That's how tokenization has been used so far. That is not really a financial product, and that's not participating in something called securitization, which is basically taking something real in the real world and turning it into a financial product. The real world asset trend is the next stage. The first stage of tokenization was literally millions of cryptocurrencies, most of which have no value. The next step of tokenization is applying that same technology, but to real world assets.
So you, again, like Larry Fink, have said that all credit, all commodities, all derivatives are going to be on-chain. Why? Why do we need this? Why is this better than the system we currently have?
Sure, so there's kind of two fundamental reasons. The first fundamental reason is efficiency, is, for example, something called atomic settlement, or T0. So the US is going to T+1, which means it takes a certain amount of time for transactions to settle. When transactions take time to settle, like 1, 2, or 3 days, if it's a $100 billion transaction, we can't gain interest on that money. So I'm stuck in some transactional system where for a few days I don't get interest on the $100 billion that I paid for something. And even a few days of 4.5%, 5.5% interest on $100 billion is a lot of money. That's a very basic example. That's an example around payments and partly collateral management. So the first thing is that people like Larry Fink are mired in all kinds of legacy problems that cost them literally hundreds of millions of dollars about how to rebalance their portfolios, about how to buy and sell assets, about how to receive payment, about how to prove things to people like the NAV, the valuation of the fund. These are esoteric middle office and back office problems, which the average person has no interest in because it's not their job, it's not their problem. But these problems are worth hundreds of billions in fees and complexity and risk. And that's one of the reasons people like him are so excited, because if you're a craftsman doing something and you had one tool and someone gave you a much better tool, you're excited about that. So that's one level of kind of why it's very important. And that's one of the big driving reasons why the DTCC, Clearstream, Euroclear, basically the three biggest clearing and settlement systems in the world are now actively talking about transitioning to this model. The other side of it is market demand, right? So the ability to tokenize things has two really great properties to it. The first one is if you tokenize traditional assets, money market funds, treasuries, you basically put them on chain, and then there's a market that wants to get them on chain because they can use them as collateral. So they can use them to back things on chain. And this is what people in the on-chain world have been doing or trying to do for many years. They've been trying to create baskets of assets that are controlled in a private key-based way. So traditional financial instruments are more attractive on chain because people want to own them on chain in a direct way where they control the asset just like they control a Bitcoin. Then there is net new assets. Net new assets are like tokenizing real estate for fractional ownership of a multi-$100 million building. Tokenizing private equity funds, where you would have had to have 5 million to get in, now it can be at 10,000. Tokenizing carbon credits, tokenizing municipal bonds, tokenizing even gold, that you can then go and redeem that gold in person against a cryptographically guaranteed token that you control, right? So then there's this whole category of net new assets that are not currently in the financial system, but once you tokenize them, tokenization is just a better, more efficient way to put them in the financial system.
Right, so digital representation of ownership of an asset on chain, on the blockchain. And how big do you anticipate this market to be?
Hundreds of trillions. Just take every market. Take the gold market, the real estate market, the debt market, the derivatives market, the securities lending market, all of these, all assets. What's fundamentally happening is you have a new format for assets, for ownership, and also for the data associated with that ownership. And the data is now appended to it in a way that proves things to you about the underlying assets. So the last time there was this type of transition was in like the 60s and the 70s, where people transitioned from paper to basically databases.
Right.
That was the last time that value, all the world's value, used to be on paper. And then databases appeared and computer systems appeared, and the efficiencies and the benefits of computer systems and databases, even before the internet, right, in the 60s and 70s and 80s, were so vast and so great that all the world's value transitioned from paper into a database record. All the world's value. It wasn't some of the world's value. You don't have any piece of value right now that you own, other than whatever you have in your house somewhere, that isn't in a database. But in the 60s and 70s, all of that value would have been in paper certificates or even other paper ledgers. So it's that type of transition where now we're going from databases, which you and me can't trust, right? So one of the fundamental differences is that you feel you have money in Silicon Valley Bank. And if you talk to people about their account in Silicon Valley Bank, they're in the Valley, they're genius, tech entrepreneurs, the US financial system is wonderful. 2 weeks before Silicon Valley Bank's collapse, it's like you ask them, what degree of ownership and real control do you have over this asset that you have in this database? They will say complete control in Silicon Valley Bank. 2 weeks after Silicon Valley Bank, you ask them, what's your relationship with this asset? It's a great question. We don't know what our relationship is with this asset. But your relationship with a private key that you control, and that private key's mathematically guaranteed control over an asset, is very different.
So does it bring ownership back to the individual
Yes.
in a more concrete way?
Yes.
Because there have been some concerns about tokenizing everything and it infringing on privacy. It infringing on decentralization in a way, it infringing on autonomy. I see you're laughing at that. Why is that comical? Why should people not be concerned about this trend of tokenization?
Because the amount of centralization and control other people have over everything they own, and more importantly, the underlying value of everything they own, is extremely high. I would say it's currently, yeah. So people are like, I have a brokerage account and I have a bank account. That's great. I control all this stuff. Yeah. Let's take a look at countries that have bank default scenarios where they institute capital controls, like Greece, where you couldn't get more than $65 a day, whether you were an individual or a business. And then take a look at the Bitcoin wallet registration numbers from that time period in Greece. And also take a look at the wallet registration numbers in what people thought were going to be the next economies to fail, like Spain. So those wallet registration numbers go up like hundreds to thousands of percent. Because people realize that their relationship with their assets is a fiction. And it's a fiction that benefits people with a brand that have over 100 years with their brand. And their logic is, I have the legal system protecting you. I could theoretically deny you access to your assets like Silicon Valley Bank did, but I won't. Because why would I? And then the situation changes, like in Greece, and capital controls are implemented, or the situation changes and the solvency of the bank is in question because Moody's decides to do their job and clarify something, even to a very small degree, and all of a sudden you can't access your life savings, right? So I think what has happened at this point is that brands and institutions are unbelievably expert at assuring everybody that they are safe and that it is safe to put your value and your assets in the system. What blockchains do, really, another way to look at it is it creates what we call the verifiable web, and that has 3 properties. The first property is that you can verify everything going on in the system Well, actually, no. The first property is you can verify how the system works before you join it. Then you can verify what's going on in the system at any one moment in time. So imagine if you knew every single piece of information that the CEO of your bank knew. Like you had access to exactly the same information. There was no delay between the solvency information of your bank and what you knew and what the CEO of the bank knew. So nothing could be hidden from you. That's the second property. And then the third property is that you can always choose to leave the system under the conditions you initially verified, right? And this is where private keys come in. So this is the new world we're kind of shifting towards.
So Sergey, in a way, it takes some power and control away from the big players, from the institutions, and brings it back to the individual.
Yes.
So why are the big institutions pushing for this? It seems like it could be counter to their interests.
It's inevitable, and if they don't participate, they will lose usership. So these are very smart people. Like the wages that people in banks and asset management get are on the high end of all wages. This attracts people for very, very smart. They're not dumb people. I interact with them on a daily basis. They're very clever, smart people. It's not like there's this huge monumental structural shift in how all value is managed and secured and transacted. And they're just going to sit, and the numbers won't go from less than 100 billion to over 2.5 trillion in the crypto industry.
Right.
And they're just going to ignore it. This is just an inevitable reality because of the benefits of this technology. It's like, right now, the internet is obvious to everybody, right? It's obvious that we communicate over the internet. We do Zoom calls, we send emails. 60s and 70s, you ask people about the internet, they're like, why would I need that? But the benefits are obvious now, right?
So if you can't beat them, join them, and this is the trend that it's going. Okay, so you brought up the example of the internet, and you brought up the example of, I guess, paper records, right? And there's always a winner and a loser in any major transformation, in any major evolution. Who are the losers? Who's going to be disadvantaged in terms of providers, in terms of institutions? Who are the players that are going to be on the other side of this when the tokenization trend really takes off?
Right, the tokenization trend and the DeFi trend in the private chains of the banks.
Right, like you had, like your publishers, right? We still have some print stuff. Listen, I'm old school. I like my hard copy, right? But obviously you had a lot of publishing businesses, just to put it on a very rudimentary level, that got taken out of business, that lost out on this. Who are the losers as this trend really takes off?
Yeah, so there's two groups. The first group is anything that can be packaged into a smart contract that some service or system charges a lot of money for. So if your financial service is doing some automated function that you do in your database and servers, and then you charge 0.5% or 0.25% in fees for that, and that can now be written in this technical agent, and this technical agent is so reliable that the chance of its failure is less than your system. And so using your system is both more costly and more risky than this technical agent that's doing some calculation or some transfer or something. And there are parts of the financial services infrastructure that fall into that. And there are other parts that people think fall into that, but actually don't fall into that. And this is where a lot of people are confused about who will be displaced, and that there will be, everyone will be displaced. Everyone will not be displaced. There will be parts of people's financial services infrastructure offerings that are replaced by smart contracts, and there will be parts of what they do that will actually become more valuable in certain ways. Like, for example, providing legal finality. So one answer is the people who create the financial system of the world and how that all works, which is complicated and varies from use case to use case. But basically, the way to think about it, anything that can be turned into a smart contract will be turned into a smart contract. That's the question you should be asking. Can this be turned into a smart contract? Yes. If it's turned into a smart contract, assume it costs less, and assume it's viewed as more reliable than a centralized thing. And then the next question is, why would someone choose this thing over that thing? Once you're in that kind of lens. And the answer is pretty much always, they would never choose the current thing. Just like we don't communicate over postal service, right? That's the situation.
I don't know. I still like getting a card in the mail every now and again, but point taken, yes.
And then the second group are the people who exploit information asymmetry, which is a lot of people in the financial markets. Information asymmetry is how most hedge funds, most places that speculate make money, legally or illegally, many times illegally. And the global financial crisis was a great example of this, where you had certain very small groups of people that had unique access to information that they were able to exploit to become massively rich, where the rest of society had to cover the cost. And that's basically information asymmetry. Now, information asymmetry is eliminated by putting the data that those people would have had on chain. So the thing that's happening beyond just the ownership right going on chain is the data is going on chain. So I'll give you an example. Let's say we had 1 million mortgages and they were bundled into some product and they were bundled into some other product. In the traditional system, no one could really understand who the mortgage holders are.
Right.
In the new system, every mortgage holder will have their own smart contract. And the second that their credit score changes, the second they buy 5 more houses, the second their wages go down in some way or something significant happens, that specific single mortgage holder's smart contract gets updated. And then the packaged asset is a collection of millions of those individual smart contracts. But you don't have to be John Paulson, you don't have to be these people, these advanced people, to understand what's going on with the underlying assets. Because all of the data is flowing into this smart contract, which is becoming what we call a unified golden record. So the second thing that's happening is the markets are getting more efficient. You have atomic settlement, huge efficiencies, which fundamentally make everything cheaper, and that value ends up going back to the consumer through competition, which is the power of capitalism. And then the second thing that's happening is the information asymmetries are eliminated, because imagine if you knew everything about an asset that the asset issuer knew. Like, one of the biggest problems of asset managers, frankly, is that the asset issuer, the sell-side bank making the asset, knows all this stuff about how that asset actually works and is actually performing. And then they get really good updates about that. And this is what defines some of the best asset managers, actually, is that they have access and understanding of that information similar to the sell-side banks. And the worst asset managers don't have that. But imagine if all of the same information that the bank had, the issuer had, was on-chain to begin with, and then it was consistently updated. So let's say we have a tokenized piece of real estate, and instead of having to have $100 million to buy into a building, we need to have $1. So we buy a portion of this big convention center because we think it's going to be worth more. And then that is an ownership right on-chain, and it is also a data container where, let's say there's a new debt obligation on this convention center. The second that debt obligation becomes publicly known in some database, it gets written into that on-chain record. And now you don't need to have access to that database. You don't need to know where to find that debt information. It is delivered to the place where you have your ownership. And this eliminates these information asymmetries, which actually are one of the biggest reasons of the size of the cyclical booms and busts of the global financial system. Because the story is always, we have this information asymmetry, there's a big boom, then it becomes apparent there's a big bust.
So with more transparent information, you see more stability for financial systems at large?
Absolutely, because just look at the basic pattern of all systemic financial risk. It's that something got obscured, like CDO managers in the global financial crisis were these very limited groups of people that knew a lot about the underlying. But the pension funds, whoever, even the scoring agencies didn't understand, right? So the fundamental problem of the global financial crisis was just an information problem. It wasn't that people were hiding the data, and it wasn't that people didn't understand the data. Some of them that had it understood it. It was just that people didn't have it.
Well, you could, not to get off topic, but you could say the rating agency did not do their job in the way that they rated the...
Yeah, because the friction for them to understand was very high. So imagine if the friction is very low. Imagine if each of the mortgage holders in a million basket mortgage-backed thing, you can know when that mortgage holder's credit score goes down.
And if he's taken an extra mortgage on another house and extended
Exactly.
his credit. I get that point. I still think we shouldn't let the credit agencies off the hook that easily.
No,
But I get the point that we have more transparency of information, which in a way helps to create more economic stability and eliminates risk. Speaking of risks, quickly, what are some of the downsides then to tokenization? Hacking, I mean, what could go wrong here? This all sounds very good. Give me the other side of this. What could go wrong? What are the downsides?
So it's very interesting with people. They say they want control, but when you give them control, it comes with responsibility and risk. And this is like a constant pattern with human beings. So they even have studies where they put them into supermarkets where they can choose 20 ketchups, or they put them into a supermarket with 2 ketchups.
They're happier with two.
People are much happier with 2 ketchup choices than 20 choices, but if you ask them, would you like more choice? The answer is always yes. And one of the key problems of our industry is the user experience. So the user experience of the crypto industry, of the real world asset industry, because of these private keys, is not good. It's gradually improving. And this is an example of a role that institutions will play. So institutions will abstract away this kind of key management problem. For that, you will cede some control, but I think we'll actually end up in a middle ground where you retain some control and the institution helps you manage the rest. So the user experience of moving cryptocurrency by like clicking little keys, little devices. I don't know if you have a Ledger or Trezor or one of these, but clicking those things is not fun. And it's not, whenever we do those transactions or we see those things, we are always joking about, this is so ready for my grandmother. I can't wait to have her, transfer some Bitcoin somewhere. And we're like laughing about the quality of that experience. So that needs to change significantly for wider adoption. But I think there will be a layer between people and that in the form of various apps, fintechs, institutions, right? So that'll be simplified partly in that way. The other thing that is a concern, frankly, is the scalability of the system. So the scalability of blockchains has not reached its full potential yet, and this is still a limiting factor. And then the 2 other big problems that the industry still faces are connectivity, full connectivity, and privacy. So full connectivity is what we work on. So we connect the largest amount of data, we connect the largest amount of existing backend systems, we connect chains in the most secure way across both bank chains and public chains. So this connectivity problem is what Chainlink is heavily focused on, and in addition to validation and other problems. And then the privacy problem is another key thing which existing transactions in the web system have. So there's a lot of privacy in how people transact today. That privacy doesn't inherently exist on chain right now. That's another limitation. But once you solve these 4 monumental limitations, then all of this is beyond obvious. And even with these limitations, you have a $2.5 trillion public chain industry. You have the biggest asset manager in the world saying that all of this is going to convert. And you have the 3 largest clearing and settlement systems of the world at this conference announcing a joint digital asset control principles framework, which they, I think, announced yesterday. So even with these limitations, right? And the way to think about that, in my opinion, is every technology kind of gets to a point and then it reaches diminishing returns. It can maybe do another 2% increase or 5% or 10% increase. Internet technologies have reached that point. Internet technologies can improve another 5, 10, something percent. Blockchain technologies are in the early to mid stages of their development, and they can improve hundreds of percent. So, yeah.
So privacy is a concern, but one that is being addressed. Now, do you foresee then a world where you no longer have paper deeds to anything? Is this just going to be completely obsolete? Give me the timeline for this then.
Well, paper deeds,
projected timeline.
Paper deeds are an interesting example because I actually, over I think 8 years ago or something, I worked on tokenizing real estate, and I found out that the way that it works in the U.S. is that every county has its own real estate registrar. So there's like thousands of these, and they're all run in different ways, and they will all work differently.
Right.
So paper deeds might take longer, possibly, but basically all of the assets, including paper deeds, will eventually be tokenized into a cryptographically guaranteed form. You'll have a private key in your phone, and I'll have a private key in my phone. And then when we sign an agreement with e-signature, right? And e-signature was also like a crazy concept, maybe, let's say 30 years ago.
Yeah, sure.
So we'll sign with the e-signature without thinking about it. And then we'll put our thumbprint in or some biometric thing. That'll go to a secure element in the phone that houses the private key. And that private key will sign the transmission of a token that represents the house from your address on a chain to my address on a chain. And we might be on different chains. So your token for your house might be on one blockchain, and my money to buy the house might be on another blockchain. And then we would need to send the money from my blockchain and the house token from your blockchain. And then that has a whole bunch of problems around it, technical problems. Those are the technical problems we deal with and we're figuring out. But yeah.
We being Chainlink.
Yeah, Chainlink, yeah. The e-signature analogies is a good one, right? There was a period where e-signature
It was ridiculous, yeah.
wasn't legally binding, wasn't the thing. People would drive, in your real estate example, to house closings. People would have to drive long distances. I know some of the people that made e-signature successful. So Tom Gonser, one of our longtime advisors, is the founder of DocuSign. And he explained to me that one of the first use cases of e-signature was actually allowing real estate brokers to not have to drive to closings,
Sure, yeah.
right? And one of the big tipping
Factor for sure.
and one of the big tipping points for e-signature was actually the U.S. Congress ratifying a law that makes it legally binding. That's actually the place we're at in this industry, where regulators in various countries, clearing and settlement facilities, central banks are now realizing that they are a blocker to more blockchain adoption because the banks, the asset managers are hounding them for clarity. People like Larry Fink and others are saying to them, I want to do more of these transactions. I don't know what's legal. I don't know if I do this, is it legal? Is it guaranteeing me something legally? And so now this year and next year, and this is some of the conversations I've been having over the last couple of months, meeting with central banks and clearing and settlement depositories and exchanges and regulators. Now we're in this world. We're kind of at that tipping point where people see the value of this, and the regulators, the lawmakers, the central banks, the CSDs are all now starting to create what they call frameworks, regulation frameworks. And those regulation frameworks will create the legally binding force that will allow the remainder of the world to transition their relationship with assets and value and the data associated with those assets and value into this format.
Right.
So this year, next year, we're literally at that point where like you're gonna get the equivalent of e-signature legislation, and that is gonna be one of the big unlocks for opening the floodgates of adoption.
So that is what you forecast happening within the next year or so, getting this regulation cleared out for?
I would say in the next 2 to 3 years, depending on the jurisdiction. In some places, it's already clear.
So Sergey, assuming you're watching the show, you're a retail investor, you see the trend, you see the writing on the wall, how would a retail investor get exposure to the upside of this? Like what's the play here?
I think generally speaking, Bitcoin is a good index for the whole crypto industry. And generally that's consistently continued to be the case.
But for the tokenization industry, is it ETH? Is it Ethereum? Like how do you play this trade, to put it that way?
I think that's very hard for me to say. I'm not exactly sure how people would approach that. I think they should have an interest in the real world assets themselves and think about adopting those real world assets like tokenized gold, tokenized fractional ownership of real estate, tokenized carbon credits. That's the direction I would think about. In terms of all the different technologies, I would kind of just look at the technology that's going to become indispensable to allowing all of this to operate.
Right.
Generally, my experience and my reading of the history of technology is that the technologies that are critical for transactions to happen, for systems to move ahead, are the technologies that when those transactions increase, people are in a way forced to adopt those technologies because they have to adopt them in order to transact.
Right. Well, I know the Link token has been on a tear. I know for compliance reasons, you're not allowed to discuss the movements of the Link token, which is obviously linked to Chainlink. So we won't address that. But you mentioned congressional approval and meeting with regulators. One of the things I want to focus on at this conference is the tremendous bipartisanship that we're starting to see regarding crypto and blockchain. We've got members from both sides of the aisle showing up at this conference, and usually it was more of a Republican issue, being pro-crypto, pro-blockchain. We're starting to see more Democrats come on board with that. What do you make of this, that this is becoming more potentially of a political issue in this election year?
Yeah, so I think there's two big trends driving this. The first trend is that the two countries that have the most negative view of crypto are the United States and South Korea. And they're both the two countries that had a huge consumer failure that affected consumers, FTX in the US and Terra in South Korea. A lot of other countries were not as impacted by those failures. And so their regulation, their legislative system has been positive on blockchains and cryptocurrencies, generating that legal clarity faster than the US and South Korea. So the first trend is that there's been a negative headwind of this kind of consumer protection. We can't let something like FTX happen again. It would be a horrible thing. We have to bring the hammer down on everything because FTX was such a painful thing. And FTX also had this wonderful added dimension to it of being somehow interlaced with the political system through some system of contributions to politicians, right? And so people need to kind of show that they're doing their job and do consumer protection to counteract the negative consequences of that, right? So there's this big kind of force there. The second big force, I think, is the election. And I think there's these surveys about the percentage of the US population that holds crypto, that is interested in crypto, that feels candidates should have a view on crypto, that feel it's a positive thing. You know, there's partly a generational shift towards millennials and others that's gradually happening. And this is frankly what a lot of people predicted, right? What a lot of people predicted is that crypto, one way or another, will become widely adopted, even in the longest time frame, through a generational shift. And when you look at the percentages of people that own crypto in the US and percentages of people that feel that crypto is an important topic for politicians to have a good view on, it basically has become some kind of campaign issue. And having the stance that like we have to kill it without good reasoning why isn't gonna work at this point, basically. The bipartisanship, I think, is very, very positive. And I hope whatever happens with the election, I hope it continues past the election. Because frankly, it's a very positive technology and industry for the whole US economy.
So there's been some speculation that the turnaround by the SEC in approving the spot ETH ETF may have been politically motivated with the Democrats seeing that they're losing voters on the crypto side. And any thoughts on that? Whether they... Okay, so you agree that potentially there was some kind of push to Gensler, make this happen.
Look, I don't know what they say to the chairman of the SEC. I'm not in those meetings. I don't know what happens there. I do feel that, and the statistics prove this out, there's a large percentage of the US population that overlaps with the large voting percentage of the US population that feels that crypto is positive and feels that it's an important issue.
So let's talk about the spot ETH ETF approval. You've said that the Bitcoin spot ETF was a watershed moment. What are your thoughts on the ETH ETF approval?
I think it's an obvious next step. I don't know why there would have been any doubt that this would have happened. And I think beyond the ETH ETF, there's going to be more ETF approvals for a whole bunch of different tokens and a whole bunch of other tokenized assets, frankly. So I think this is just the beginning. This is just the beginning of the traditional financial system finding a legally compliant way to interface their user base with the crypto industry.
Well, big development. None of the actual ETFs have been launched per se. Obviously, that paperwork is going through. Some expect that to be ready in June, maybe July. What do you think it means for the price of ETH? Because it still hasn't made a new all-time high. Do you have any thoughts that you can share on that?
I think if I had to guess, I'm not an expert on how market prices work, but if I had to guess, once people saw that one ETF was approved, I think then it was probably priced in that other ETFs would be approved. That would be a logical assumption from a rational market participant. I don't know what it'll do to the price of the ETF. I think what people need to see is the amount of value in the ETFs, right? So I think that the way to measure this is not that there will be an ETF, but how much value from the traditional financial system, which is net new buying power, net new capital flowing into the crypto industry. How many billions is that in the ETH-ETF? So it's not about the launch of ETH-ETF. I think that was kind of obvious. I think the next question is over the next weeks and months, how much value are in the 10 or 20 different ETFs that are going to exist? Is that in the single digit billions? Is it in the double digit billions? How many zeros are there?
So are you overall optimistic in terms of a continuing bull market run for ETH, for Bitcoin, whatever you can share on that? I know your compliance people behind my back, so whatever you can share on that.
It's fine. I think that frankly, a lot of the crypto markets are driven by macro forces that are beyond people's control, like the Fed interest rate. My personal view is that it's driven by a lot of macro forces. These macro forces are very unpredictable. They're tied to inflation, which is tied to geopolitical events, and like a multitude of different supply chain issues that are very hard to predict and understand. So there's this kind of chain of events between geopolitical events affecting inflation, inflation numbers affecting Fed interest rates, and Fed interest rates affecting how different types of commodities and assets are viewed, right? So that's a super unpredictable dimension of the crypto industry that good luck figuring that out. I think the adoption of the technology is at an all-time high. And I think the value of these cryptocurrencies is also at a high enough price to attract people into the crypto industry. And when I've seen this in the, let's say, 14 plus years that I've been in the crypto industry, you basically see two trends. You see price bring people in, and then they stay and build cool things. And then sometimes you see cool things being built, and that validates the value and usefulness of the technology, and that brings people in. I kind of see both of those trends happening right now. I see that the market prices of things like Bitcoin are high enough to justify smart people to come in and build things. And that has a lag between when they come in and when they launch what they're building. That lag is anywhere from 6 to 12 months. But I am seeing those people come in, and I am seeing a lot of cool, thoughtful DeFi, RWA, like really high quality teams. Like we work with a lot of teams, like I would say the thousands of teams, the best teams in the industry work with us for the security and the data we provide. We power the majority of DeFi. We've processed over 10 trillion in transaction value across the most widely used applications. So we see who is coming into the industry, what the quality of those engineers are, the founders, and so on. The quality is consistently high over the last, let's say, 6 months, and the value is high enough so that people will stay in the industry and build things. My view is that if the industry builds valuable things, then the industry will have value over time. What the short-term fluctuations will be based on will probably be based on other things that the industry doesn't have a ton of control over, but the value that the technology provides over time is what will define the value of this industry over time. And the value of the technology, for me, is an inevitable transition of all the world's value into this format. And then there are a few key tools and protocols and systems that will both power that transition and allow that transition to function at multi-$100 trillion scale. And that's the type of thing that we're trying to build in the Chainlink community.
So overall, clearly very bullish on the market.
I've spent over 10 years working on it, and I'm more than happy to spend another 10 years.
What would you say, as we wrap up here, is your biggest prediction for where we'll be in the blockchain space, in the cryptocurrency space, in the next 3 years?
I think we'll see the launching of more capital markets products and the flow of more capital markets TradFi money, which is hundreds of trillions of dollars in value. So the traditional model of the cryptocurrency industry has been retail, prop traders, hedge funds, dabbling and dealing with crypto. I believe that can only take the industry to maybe 10 trillion, but probably not much further. The traditional financial system has hundreds of trillions of dollars in value. And over the next 3 years, I think we're going to start to see the transition of that value into public blockchains and private blockchains. And this transition of value is the net new capital that will drive the growth and the adoption of blockchain technology generally. So this is the thing that I think is happening over the next 3 years. This is the work that we're doing with SWIFT, the DTCC, large other financial market infrastructures, some of the work we're starting to do with central banks and other big kind of infrastructures, as well as some of the world's largest banks and asset managers. I'm a very firm believer that the future of this industry is both the retail, prop trader, hedge fund community and the mainstream global institutional and retail world, allowing their regulated value to flow into blockchains in a regulated, compliant way that manages risk for them in the ways, and legal risk, in the ways that they find important. And that this is the thing that will take our industry to completely new levels of adoption. So this is the thing that I'm very focused on, and I think is going to be happening over the next 3 years.
And very quickly, what have you gathered from your recent conversations with central banks? You said you've had quite a few meetings recently. What can you tell us about that?
So central banks want their economy, their country's economy, to grow and to have valuable transactions that the monetary system helps facilitate. And so digital assets are emerging as a category around which transactions want to happen, right? And central banks are in a position where they have to create some form of payment that exists on chain.
Right.
So if there's a whole new category of assets that people want to buy, cryptocurrencies, real world assets, DeFi protocols, if there's all these systems and things that the country's investor base, the external investors of the country want to invest into the country through, they want to use this asset type, this format, they will want to do that through a riskless form of payment. And this is, I think, what the central banks are thinking about is if the digital asset economy becomes a significant part of both foreign direct investment and commercial local activity, how does the monetary system interface with that asset? And the answer is that you need an on-chain form of payment, whether that's a stable coin, whether that's tokenized deposits from banks, or whether that's a central bank digital currency or private bank money, right? Those are the main options. And central banks see themselves as facilitating economic growth and activity in their market and facilitating economic growth and activity through foreign direct investment. And so they are driven by the asset side. I think as the asset side grows, the significance of having your monetary system in your country interface with digital assets by having an on-chain form of payment that you endorse and is considered riskless and doesn't create systemic financial risk for your domestic economy or external investors is going to be one of the key factors for the success of digital assets. And so they're viewing it in that lens of how do I create a form of payment that doesn't create problems for the current economy, that doesn't create problems for the banking sector, but does facilitate this digital asset economy growth and usage.
All right, Sergey, we're going to have to dig deeper into that another time because I'm afraid we're out of time for today, but really appreciate you breaking everything down so thoroughly for us and giving us your insights. Thank you so much for joining us.
My pleasure. Thank you for having me. Thank you.
Thank you.
Getco News special coverage of Consensus 2024 is brought to you by Diamond Standard.